On September 15th, 2008, the world woke up to shocking news. Lehman Brothers, a financial giant with more than 158 years of history, had filed for bankruptcy. Overnight, one of the oldest and most respected investment banks on Wall Street had collapsed. This was not just another company going out of business. It was the fourth largest investment bank in the United States, a pillar of American finance. And yet, in a single weekend, it fell apart. People on Wall Street could hardly believe it. On that Monday morning, employees carried boxes of personal belongings out of the Lehman headquarters in Manhattan. The image became an instant symbol of the crisis, a symbol of how fast trust and power could vanish. The fall of Lehman Brothers was not only the largest bankruptcy in U.S. history, it was also the turning point that sent the global financial system into free fall. But why did it happen? Why did the government stand by while Lehman went down, even though it had stepped in to rescue others? To understand the collapse, we need to rewind. We need to see how one of the most powerful banks in the world built its fortune, why it gambled so heavily on the housing market, and how one weekend in September changed the world of finance forever. To understand why Lehman fell, we have to look at what the bank had become in the years before 2008. Lehman Brothers was once a conservative investment house. But during the housing boom of the early 2000s, it transformed into something else. The bank saw an opportunity in real estate, and it went all in. Lehman borrowed huge amounts of money to buy mortgages and bundle them into securities. These were called mortgage-backed securities, or MBS. On paper, they looked safe. In reality, they were built on risky loans given to people who could barely afford them. The more Lehman packaged, the more money it made. Soon, it was creating even more complex products called collateralized debt obligations, or CDOs. These were sold all over the world as if they were gold standard investments. Ratings agencies stamped them with AAA approval, telling investors they were safe. But they were not. Lehman also leaned on leverage. For every dollar of its own capital, the bank borrowed as much as $30 more. That meant even the smallest drop in the value of its assets could wipe it out. It was like a skyscraper built on matchsticks, impressive from the outside, but dangerously unstable inside. At the center of it all was CEO Richard Fuld. For years, he pushed the bank to grow bigger, to take more risks, and to chase higher returns. Inside Wall Street, he was known as the gorilla, a symbol of toughness and dominance. But behind that image, Lehman was becoming more fragile every day. By 2007, cracks were forming. The housing market began to cool. People started defaulting on their mortgages, and the very products that Lehman had piled up by the billions were turning toxic. The stage was set. All it would take was one shock to bring the whole tower crashing down. By the summer of 2008, Lehman was running out of time. Losses from its mortgage portfolio were mounting. Investors had lost confidence. Its stock price had collapsed, falling more than 90% in a matter of months. The bank needed a savior. For weeks, Lehman tried to find one. Talks with Korea Development Bank went nowhere. Potential buyers circled but walked away once they saw the scale of the toxic assets on Lehman's books. That left one final weekend, September 12, 2008. At the Federal Reserve Bank of New York, top Wall Street executives gathered with government officials. The goal was simple but desperate. Find a buyer for Lehman before markets opened on Monday. Two names came up: Bank of America, Barclays. Both were interested, but both wanted guarantees. They wanted the government to backstop Lehman's losses. Treasury Secretary Henry Paulson refused. After bailing out Bear Stearns months earlier, the government drew the line. No more rescues, no more moral hazard. Negotiations dragged on through Saturday. By Sunday, it was clear there would be no deal. Barclays could not get approval from British regulators. Bank of America turned instead to Merrill Lynch. Lehman was left alone. In the early hours of Monday morning, Lehman Brothers prepared its bankruptcy filing. $600 billion in assets, the largest bankruptcy in American history. That morning, the world saw the images. Employees in suits carrying cardboard boxes out of the Manhattan headquarters. A 158-year-old institution reduced to rubble in a single weekend. The fall of Lehman Brothers was no longer a possibility. It was reality. And the shockwaves were about to spread far beyond Wall Street. The collapse of Lehman Brothers was like pulling a thread from a tightly woven fabric. Within hours, the entire system began to unravel. On that Monday, the Dow Jones Industrial Average plunged more than 500 points. It was the worst single-day drop since the attacks of September 11th. Around the world, markets followed. London, Tokyo, Frankfurt. Billions of dollars in wealth vanished overnight. But the bigger danger was not the stock market. It was trust. Lehman had been a cornerstone of Wall Street. If Lehman could fail, who was safe? Banks stopped lending to each other. Credit markets froze. Companies that depended on short-term loans suddenly found themselves cut off. The ripple effects were immediate. Hedge funds scrambled to pull money from prime brokers. Money market funds, once considered as safe as cash, broke the buck when they realized they held Lehman debt. Panic spread through every corner of finance, and Lehman was only the beginning. Merrill Lynch rushed into the arms of Bank of America. AIG, the insurance giant, stood on the edge of collapse. Citigroup and Morgan Stanley looked vulnerable. It seemed as if the entire financial system was standing on quicksand. In Washington, lawmakers faced a nightmare. To stop the bleeding, they drafted a massive bailout package, known as the Troubled Asset Relief Program, or TARP. $700 billion to stabilize the banks and unfreeze the markets. But the damage was already done. The fall of Lehman Brothers had shattered confidence. It turned a financial crisis into a full-blown global panic. Lehman's bankruptcy was more than a single corporate failure. It was the spark that turned a financial fire into a global inferno. In the months that followed, the United States slid into the worst recession since the Great Depression. More than 8 million Americans lost their jobs. Millions of families lost their homes to foreclosure. Entire communities were scarred as businesses shut down, and unemployment lines grew longer every week. Across the Atlantic, Europe felt the tremors. Banks in the United Kingdom, Germany, and France had loaded up on American mortgage securities. When Lehman collapsed, their balance sheets imploded. Governments scrambled to nationalize or bail out major institutions to keep them alive. The crisis quickly became global. But the impact was not just economic, it was emotional. Ordinary people lost faith in Wall Street. They saw bankers rewarded for reckless bets, while taxpayers footed the bill for bailouts. The anger fueled protests like Occupy Wall Street, a movement that demanded accountability and questioned the fairness of the financial system itself. For Lehman, the fall was final. $600 billion in assets locked in bankruptcy court. Thousands of careers ended overnight. Richard Fuld, once the feared gorilla of Wall Street, was hauled before Congress, grilled for the decisions that led his bank into ruin. His reputation never recovered. In the years that followed, governments responded with sweeping reforms. In the U.S., the Dodd-Frank Act imposed stricter rules on banks. Globally, Basel III required higher capital reserves and stress tests. Regulators vowed never again to let leverage and shadow finance grow unchecked. Yet, for all the reforms, Lehman's collapse left an open question. Could another failure of that scale ever happen again? Or had the world truly learned its lesson? The collapse of Lehman Brothers is more than a story from the past. It is a warning, a reminder of what happens when risk piles up unchecked and when greed blinds even the most powerful institutions. Lehman showed the danger of leverage. The bank borrowed $30 for every dollar it actually had. That kind of imbalance can work in good times, but in bad times, it is a death sentence. It also showed the danger of blind faith. Investors trusted ratings agencies, regulators trusted the market, and executives trusted that housing prices would never fall. Each of those assumptions proved wrong. Perhaps the most enduring lesson is that no institution is too big to fail. For decades, Lehman had been a symbol of Wall Street's strength, yet in a single weekend, it disappeared. Its fall revealed how fragile the global system really was. For ordinary people, the message is personal. Do not assume that prices always rise. Do not assume that those in power always know what they are doing. And remember that the consequences of financial excess are not borne by banks alone. They are felt by workers, families, and communities everywhere. Today, the building that once carried the Lehman name is just another piece of Manhattan real estate. The logo is gone, the bank is gone, but the lesson remains. The story of Lehman Brothers is not only about a bank that failed, It is about a world that believed risk could be hidden, profit could be endless, and collapse could never happen. Until it did.